Okay. You paused it. I didn't realize you paused it.
Hmm.
I have to keep an eye on you.
As soon as I walked in with the record, I was like, hey, hold on, Ramesh wants to come in. Hey, Shane.
Hey guys, how's it going?
Good, how are you?
Doing well, thanks. Doing well.
How warm it is out there.
Yeah, it's beautiful. It was like 55 degrees today.
That's it. Okay, okay.
Oh,
You
man.
know, it's just 70s down here.
Yeah, I know. Just the typical Houston weather.
The Shane is the same workflow, same cadence. I had a couple of slides in it, but we'll just similar process.
Yep, sounds good.
Thanks. Hey, Cart,
Hello, everybody.
how are you? It's been a while.
Good,
Hey,
thank
Kurt.
you. And
Hey, we need to get one of those tankish nachos one more time when we get to Dallas next time.
we can make that happen.
That's I think that may happen next week too. So just wait.
Yeah.
Hey, Simon, good to see you, buddy.
Hey, Kurt, I just sent you an email.
Oh, yeah. I greatly appreciate it. I got a quick read of it. Very thoughtful. We'll follow up accordingly as you
Sounds
described.
great. Sounds
Thank you,
great.
sir.
I'm pretty anxious to work together.
Thank you. Likewise. There might even have to be nachos involved again.
Oh, yeah, that's right.
Not just a simple one, big one, right? Like a real
Big
gun.
one.
Big one. Man, that was a tank.
Exactly.
That was fun.
I'm yet to see a cake, cut it out in the middle, put nachos on top. That was a good one. I think we should give Shane an example of it. How big is Texas, right? At least I've got tips and cases. No, Shane, I mean, it was big. So we went in for nachos, right? We were like, okay, yeah, you want some chips and queso? We said, fine. And they brought out, it's like literally the cake, they cut it and they flipped it and put all the chips and queso on top of that. It's like a tank this big, huge.
Well, that'll definitely fill you up, right?
That's true.
Yeah.
That's true. Hey, Ryan.
Hey y'all, sorry, I was on mute there.
Hey, Shane, how are you?
Hey, good, Simon. Good to see you.
Been a while.
It has been. It has been.
Hey, Schreier, Simon needs a pass for Maine.
And it's what, sorry?
He needs a pass for Maine.
Yeah, the PSC people.
I sent you a text message.
Okay.
The weather in New Hampshire, is it cold yet?
You know, everything's relative, right, Simon? It's, yeah, it was warm in kind of,
Okay.
mid-50s and rainy today. That's
Got it.
warm for us. But yeah, in general, it's been 20 something degrees every morning and it's starting to get chilly.
Yeah, for us, that's really cold.
Yeah, I know.
It is cold. That's not really cold. It is cold. Don't
It's
get out of the
cold.
house cold.
It's cold, but yeah, strangely you get used to it.
That's true. So got a couple of more minutes, then maybe 6:05, we'll get started. Let me check. Mike, do you see Ash if he joined in or not? I don't see him. To Simon, I'm gonna, no, I'll find the pass for you for the main event. Gotcha.
For the whiskey, cake event?
Yeah, whiskey cake. Just show up, man. I mean, it is, you know the address. I'll text you the address. So don't worry about it.
All right, man. Appreciate it.
No problem. Hey, Jasmine.
Hello, hello. How you guys doing?
Good. You're having too much fun. I see that. Oh,
Just walking outside.
nice. So we'll get started in about a minute or so.
I think here's Ash coming in.
It's coming in. Okay. As soon as it comes in, we'll get him started.
Let him say hey and get set.
Yeah, hey Mike, how you doing? Here we are. How are you doing, man?
Hey, man.
Good,
Good. How are
Jonathan.
you?
Good to see you.
Thanks
Thank you
for
for the
joining
invitation.
the Spanish webinar earlier.
No, it was great, man. It was great. I already, gonna send the recording for some people that actually they are really interested. So, man, these girls they kill it, man. That's how it is.
I missed it. I had to pick up my son from school. I was like, I don't want to be on the phone when I'm driving. I was like, fine.
We're trying Ash again. Yeah, it was really good. Great work by Monica and Jasmine and whoever, the others that supported them. So Shane, they did a Spanish webinar for McCallum earlier today.
Yeah, I saw that. That's amazing.
So and we had
Hey, Ash.
quite a few people on from south of the border, from some people from Uruguay and Colombia, I think, some other places. So
Hey, Jonathan, I gotta ask you, do you know a Fabiola Araque?
Viola, no. That's kind of weird that you know somebody with my last name. Actually,
Yes.
not many people, but no, I do not.
Where do you live, Jonathan?
Right now I'm in half Dallas, half Wisconsin. So I have all my clothes on my car in Dallas, and I'm here with just the same clothes every day in Wisconsin until I move my furniture.
Well, the Ariake I know was from Ecuador.
Ecuador, yep. It's good.
Mike,
You
I
guys
think
wanna
Ash
go over
joined.
this, webinar.
yeah, Ash, are you with us?
Yes, Mike, I am. Hello, everyone. Good evening.
Hey, Ash. Good evening.
Thank you for joining, Ash.
Thank you for joining, and we'll keep getting people admitted in, and we'll go ahead and get kicked off for this evening. This is, our following up Massive Capital continued with our webinar series. Tonight, we're gonna, continue some discussions on McCallum, and part of the reason is we want to get more, continue to get more introductions into our deeper team. Is part of the reason for that, and allow others to keep, getting a chance to see this. We have, a lot of support coming in, and just want people to, continue to have the opportunity. So part of it, I'll let Shrar get into the details of the slides, but again, we'll touch later. Just some people have events coming up. We're looking, to be in Dallas Friday, Saturday. So if anybody actually wants to, we're looking, Shane, I've been talking with Kevin to schedule a tour on Friday afternoon with a few people. There's a little event going on with Sumrock, so some of us may be joining over there. And then the following weekend, just for people that are interested to join, we'll be in Miami or Aventura, actually, at a 10X conference with Cardone. Massive Capital and Legends Equity is putting on a couple mixers or meetups, if you want to call it, after the event on Friday and Saturday night. So more information will come for that. So let us know, keep in touch, and we'll keep sharing. We'll be having continuous every Wednesday. We'll be here, and be, sharing more content as we go ahead. So I'll turn it over to you, Schreier.
Mike, thank you. And I really appreciate everybody for joining tonight. So this is our third webinar for this project, McCallum Properties. And one of the addition that we had is that we're going to talk about the deeper team and that how some of our friends and partners and advisors are helping us looking at some of those big ticket items, big projects, short term and a long term, and also helping us with their expertise as we are growing. So I'll go a little bit more backwards. And on that note, what I would do, so this is again, it's a full disclaimer. It's a 506C project. Everybody here actually an investor. So please, as you listen to us, use your own analysis and make choices accordingly. So again, a sponsor team. So we'll talk about the teams that will be running the assets a little bit on the tail end of it, but we're going to show you the inside out, which is who are the advisors or backbones of Massive Capital, and then how we get influence per se, and then how we are partnering with Shane's organization. So first off will be one of our partners and our core partners per se. Our strategic partners is PSC Properties. And Paul, what I will do, I'll bring in your slide deck as you kind of go through from here, just to kind of get you started. So please,
Sure.
Paul, it's all yours.
Hey, thanks, everybody. Nice to meet everyone. We're really excited about this project. I want to say off the bat, and hope this is something that fits into everybody's portfolio. We are PSC Properties. We are a family company, started about 25 years ago. And we've kind of started like everybody else. We started with some single family. We did some lake lot flips at one time. And we eventually got into multifamily and taking it from there. We have a company up north and we grew that company over several years as well. I actually started as my life as a physician and surgeon, and I've been a head and neck surgeon for the last 31 years. And I just retired last year. Alongside of that career, I had the real estate piece with our family, and we've had that for, like I said, 25 years or so. We up north, we've developed quite a few properties. We have probably now been in a little over 40 full cycle syndications. Right now we have about 1,600 units under management. We have about 1,000 units under development right now, under construction. And we've kind of taken part of our family company now here in the South to Texas, and we've been partnering with Massive Capital, and we've really enjoyed our relationship with them and taken this a little further. So we have a couple of our other members of our family I'd like to introduce is my son Ryan. And Ryan, you want to say a couple things?
Sure. Hey, everybody. Thanks for coming out tonight. I'm Ryan. I do a lot with the operations of PSC, but previously I was a biology major following the medical track as well, but decided to get my real estate license about 6 years ago. Initially started as an analyst helping Legacy, which is my dad's sort of bigger company in the Midwest, then worked as a wholesaler here in Austin before joining PSC in the family business full-time about 4 years ago. And then kind of helped us get sort of situated here in Texas, got connected with the big dogs and Canis Major. And then we met Massive Capital about 6 months ago, where we've had, a really great relationship and have gained a lot of value from our partnership. And so including this deal, we've really loved working with Massive and see a bright future with the way things are going.
Thanks, Ryan. Ryan does a lot of our asset management as well, and even some property management. So we really appreciate all his work. My other partner here is Lacey, my daughter. Lacey, you want to say a couple things?
Yeah, hi, I'm Lacey, the lead in journalism.
Lacey, you're not coming through very well.
Sorry, I think
Maybe
Yeah.
try that with the headphones. Yeah.
Yeah.
Sorry. Can you hear me better?
Hold the.
Can you hear me better now?
Yeah.
Yes.
Yes. Okay. Sorry, I think the microphone was on this phone. I am the creative lead.
No, we lost it again, Lacey.
That's the headset. I see.
I don't know. Try that.
Just try without the headphones.
We hear
Yeah.
Paul.
No, we hear Paul.
We hear you laugh now. Maybe it's
That's
I don't know this.
this is under pressure. It's okay, Lacey.
The
Relax,
youngest,
buddy.
most tech savvy one is having issues. Yeah.
It's because she was helping Paul earlier.
That's
Oh,
right.
exactly.
She
I'm
saved
sure.
Paul.
Okay.
Yes,
Back to old
beautiful.
school. Can you hear me?
Yes.
Yes.
Awesome.
Yep.
Okay.
Sorry
Sweet.
about that.
No, sorry about that. We've been trying to figure out our technical issues. Like you said, my name's Lacey. I am the creative lead. My background is in journalism. I got my bachelor's in that. I worked as a copywriter for a while and then got my master's in graphic and web design. So my role is to design and manage all of our marketing assets, like our newsletters, our email campaigns, websites, all of that. My main goal is just to make sure that across all of our channels, everything we put out looks like it's coming from one cohesive brand image and voice, so that we can really reach our target demographic and help strengthen some of our investor relations.
Yeah, I want to just reiterate, it's been really fun. If any of you ever get a chance to work with your children, it's been a pure joy. And of course, they do everything I say, and but it really has been fun. And you know, they each bring so much to our company. Ryan does a lot of the logistics and the financials and all of that, and all of this stuff that you're seeing on now is all Lacey's design and all that. And she really, I think, creates a culture for us. We hope to connect with our investors in a very meaningful way, and Lacey's really been helpful for all of that. And I'll finish by saying that one of the other asset classes that we are into is medical office. And so we will be sending out some medical office deals here soon. We have an ER, we have some other really nice kind of medical office pieces. It's the triple net kind of scenario, and very stable assets that are great during recessions. And so we'll talk more about some medical office here in the future. So entertain any questions or anything from anybody. And again, love to connect with everybody, see our website up here. And again, we're very supportive of Massive Capital and all that they do for us, and hopefully we add value to them.
Thank you, Paul. So really appreciate all the support, and as you guys, and for everybody and others who doesn't know Paul and Ryan and Lacey, they have been instrumental for our growth. And if you think about it, for us, we take a look at it, buying assets in real estate, it's a risk, so we manage the risk. Having a partner who can advise us and partner with us on a new development takes a certain skill set than running an existing asset versus running a triple net asset, right? Having a partner who goes across the asset classes is extremely beneficial. And when we get confused, here we go, we have one person to lean on to who kind of puts us in the back on the track. So Paul, thank you. And Lacey, sorry about butchering your colors. I know it's my that side of the brain is kind of dry, so thank you for being patient with me as well.
No worries.
Thanks. All right, now this is our second partner, Ash. And again, he's one of, I would say, one of the senior general partners or senior investor that we call it senior. That means at least you've been in the game for 10 years. You have a portfolio over $500 million or more, and you've gone through some cycles of it. So when I think about Ash he has been extremely flexible with us. Every time we needed something, he's on one text away. Anytime we're about to do something that doesn't make sense or we get confused, again, Ash is our second and a pillar, I would say, for us. Ash, if you're here, if you don't mind, introduce you a little bit, and
Sure.
with us.
Thank you, Sharar. Appreciate the introduction, and thank you, Paul and the team, the entire massive team, Mike, Ajit, Sanjay, for partnering with us on this deal and many more future deals to come in the future. I'll give a brief introduction. Again, my name is Ash Shah, founder and president of Impex Capital Group. I'm personally a serial entrepreneur. Started out in the plastics packaging arena almost about 28 years ago, and then sold the business to a private equity group, and have been very active in commercial real estate for the last about 10 years. Within that, pretty diversified portfolio in different verticals, and including multifamily, which is one of our sort of premier, one of the pieces of the whole portfolio, which is now over 10,000 units and total about $1.8 billion of total AUM, mostly within Texas, and some assets outside of Texas as well. So again, initially what started out as me investing through my family office, and then diversifying and getting other both retail and institutional equity investors, we've been able to grow the business to about 58 properties over the last 10 years. And it is indeed a pleasure to partner with great companies like Massive Capital. And again, I try to offer not just bringing in the capital and the loan guarantees, but also sort of guidance, mentorship, and so on, with having been in this business for many years. So again, a pleasure to be on this call, and thank you, and looking forward to working with you guys.
Ash, thank you. And just we don't know how else to say amount of time we've been spending together, and including the Paul's team, PSC, and Ash. We talk twice a week, 3 times a week, 4 times a week, sometimes 10, 15 hours a week. We're on the phone running deals. So thank you, everybody. So having those two partners, I'll go to my slide next. So I'll give a little bit about, so let me start with Hampshire. Hampshire, Shane, would you mind? And introduce your team, then I'll go last, and then I'll get into the project.
Sure. Yeah, absolutely. Thanks for making me go after everyone with much more experience and knowledge than me. That's very humbling, and I'm honored to be amongst them all. So thank you for that. So yeah, I'm Shane Carter, based out of New Hampshire. I've been doing real estate construction development for about 25 years, and done about a little over 5,000 units between my partner and I, Nick Bouquet. So we started Hampshire Capital only about just about 2 years ago. And prior to that, Nick was in the LIHTC business, did about 2,500 units there. And I had developed about and owned about 200+ million of assets, and developed about another 110 million through my construction development firm. We joined forces late in 2020. And we've acquired about 2,000 units and another, 220-ish million of assets under management currently, and excited about our growth trajectory, and obviously excited to be partnered with all these amazing people with the Massive Capital team. So our lead asset manager, VP of Asset Management, is Kevin Groh. He's a Texas-based asset manager. He's got over 27 years of experience working directly in large portfolio multifamily assets. He's well in excess of $1 billion in assets is under his umbrella for what he's managed, and he brings a wealth of knowledge to our team, and we're honored to have him as part of our staff. We also have a construction manager that is a Dallas-based full-time construction super, Philip Grills. a couple of asset, managers that are junior to Kevin, an analyst, and 3 acquisition guys that really help us in our core markets, which are really just Texas, Carolinas, and Florida. And so that's where those individuals are based. And so we find it extremely valuable and important to have local partners in every single MSA that we work in, for that really local knowledge, the local contacts. Of course, Nick and I fly to every asset and every MSA, but it's still extremely valuable to have members of our team physically located there as we continue to grow. So thanks, Shar. I appreciate it.
Thanks. Thank you, Shane. So as you can see, we have Ash and we have PSC and Paul. Then we have Shane. In 2 years, they have done great things within the multifamily sector, as you can see from his previous experience, and Nick's kind of builds up to that. So on that note, I'll go to introduce our team. So we're Massive Capital. We're about 10 months into the game under the multifamily sector as a team. All of us, we played solo before. I think the minimum, each of us, we're in real estate about 4 or 5 years or so. I'm the youngest one in terms of a timing perspective. Having said that, individually, if we tallied up what we have purchased, so Massive Capital as a team, last 5 years, we bought about 400 properties across all asset classes. Single family land, triple net warehouses, strip centers, boutique office apartments, you name it. So after going through all the analysis and the downturn and the economic forecast, we decided to build an organization. So we decided to build the Massive Capital team. And that's how Sanjay was recruited, I was recruited, Mike was recruited. All of us, we recruited each other. And at a minimum, we all have seen each other's work for at least 3 years. And that's how we started. So Sanjay is our COO. He's based out of Dallas. He is full-time multifamily for the last 7-8 years now. A typical corporate background, then full-time real estate. And he rotated about a full cycle, about 9 assets, mostly in Dallas area, in Houston and San Antonio. Then it's me. I work at Shell. I used to work at Shell per se. I have 2 more weeks. Now I'm full-time real estate now, and I have done about a little over 400 units. And so that's I work as a CFO and also look at the strategy of the company. And we have Mike here. He's being, what I can say, he has closed over 3,000 units in the last 16 months all by himself. And I'm thankful he did half of that under Massive. So that's Mike. He works as CIO, all things investments. He manages that. Behind us, we have some superpowers. We have Jasmine, all things investor relations. She is fantastic. She runs she works in the shadows, all things that we do. She influences it. We have Ramiz on the call. He is our acquisition manager. I believe, Ramiz, correct me, last 3-4 years, he closed over 200 properties. So he has a lot of firepower to it. And we have a full-time finance manager, Bhaskar. He used to work at Shell, then an expat in the Middle East, and went back to India. He works from there. He's a full-time finance manager, at least 8 years of FP&A background. And we also have Candice. She also does investor relations, and she has her own business as well. That's our team. And Hampshire and Massive Capital were introduced with a common friend of ours. He's another senior player in Dallas area. And when we saw the team, we saw how the team has grown, how the team culture is, and what their specialties are. And one of the great things we liked about Hampshire, that their specialty is the institutional grade investment and the institutional tax. And given the markets, given where we are, we like to work, we like to stay nimble. And we also are heavy on the retail LP check. So given the project that we'll talk about, you'll see how both of them blends in nicely, where we have institutional check, it's institutional grade investments, and risk perspective makes sense. Then once you couple that with the LP investment, put together is beneficial on both sides of it. That's that. And also our core markets that we play within, and that's kind of an overlap with each other. Within the Hampshire and Massive Capital, we have assets in Denver, Dallas, San Antonio, across the whole, a little bit extended Sunbelt assets. And Dallas is our core, one of our core focus. One of the caveat that one of the numbers or data point that we have about Dallas, we have modeled it quite a bit in terms of what happens in a recession and which of the cities will come back stronger than a recession. Dallas tends to come back much stronger than any other large MSAs, given all things equal, and which is also why we are very bullish in the Dallas area. Not because everybody wants to go to Dallas, right? But we also see the post-recession, which is next year, how Dallas bounces back compared to the Houston and other markets. So and that's why when we saw this project, we thought it was a great mix. across across the Massive and Hampshire, with the McCallum, we're about 2,400 units. As you can see, we can overlap. And when we saw the property, when we saw the financing structure and the balancing of the risk and how we can bring in our local expertise with the Hampshire expertise, it just made sense. One thing to remember that as we're looking into the deal, at a 350 units or higher, every single thing redundant. That means you have 2 maintenance, you have 2 assistant managers, you have 2 leads. So if someone gets sick, it's not like everything stops or get phased in. You have a redundancy, everything moves forward. So which is also why it is nicer to have the true definition of economical scales right there. So that's that. And so I'll get into the project a little bit. So let me kind of walk you through the high level of the project. And then Shane, I'll pass it on to you to talk about the details a little bit more. For us, when we run the model, we believe the context of the numbers are more important than sometimes the numbers. Understanding how the numbers came together, it's kind of important to understand. So I thought I'll give you some example of some keynotes of how we have underwritten this asset. So we are heavy on relationship. We believe relationship is an unfair advantage within the real estate segment. And Hampshire was able to exercise on that one. We knew we as a collective team knew one of the GP team from the seller. And based out of that, we're able to get the deal before it touched the broker. And Hampshire was fast enough to put it under contract and before picked up by Northmark. And I also believe, Shane, correct me if I'm wrong, that within 22 days, we had the full capital stack done, at least on paper before we put the PSA. So it had the demand for it. On the seller side, they are professional syndicator as well. And some of you guys may know them already. They are, their business plan. We had their OM from before. The business plan was for 5 years, and the market accelerated the business plan in 3 years. So it was time for them to exit. And they also didn't want to go through the cycle that we're going through now because we have a couple of more rate increases coming up. So they were also ready to sell. So when the offer was made, looking at the team and the capital stack, the contract was there. One thing to remember, historical operations, is that the Weiner Multifamily was the management company for this asset 2.5 years ago till last year. They went bankrupt. As they went bankrupt, this property took a major hit. Economic vacancy went down to low 80s. And as you know, on a 400 to 500 units, it's a big major ship to kind of turn around. It just takes time. So that's one of the reasons they pushed for paying tenants rather getting the high rent or the market rated rents, which is why we saw there was a value add setup for it. And also, as you walk the properties, if you go there Friday or you drive by in Dallas, you'll see the properties next door. It's like a butterfly wing, literally next door. They finished their business plan. They went through their high grading of it, exterior and interior, and they are getting $200 to $300 higher than our in-place rent, which is our neighbors went through the value add process. It is nicely set up for us to go through process. So you'll see in the valuation that why we're thinking the value add that we have, it's easier for us we'll be able to get. Then last couple other things is the institutional partner. We believe it's a very strong project based on our project economics and the location. We're able to partner with Walker Dunlop, and they gave us a $19 million check at a 12 IRR. And also it's from the $30 million raise when they offered us a $19 million, they also wanted to be the first one to get some of the cash back. In return, since they get capped at 12 IRR, some of those benefits of the project went back to the LP as a trade-off of the first year return. So all in all, you'll see as you get into the next slide that IRR for this particular project, as well as the multiples are pretty high compared to the norms that we see today. Even though the next project that we're going to do, we have it under contract, much less than what it is because of the IRR distribution. Last thing is that we closed the property about 5 weeks ago. We had a 1031, $6 million 1031 supposed to come in. The sale didn't go through. So we were short of about $6 million. So we came in, we took a short-term loan, we closed the property, and now we are raising to backfill that equity, which is why we're here today. That's that. So having said that, this is, we believe Dallas is a much stronger MSA to ride the inflation, also capture the growth, and also it comes back stronger, statistically stronger compared to any other MSAs that we know within the Texas. So IRR is 24%. It's a 2.9, 2.85 multiple. It's going to be about 4.5, almost 4.7% cash on cash return average, 8% pref, 75-25 split. And this is the last year of 100% depreciation, as you know. So what it boils down, every 100K of investments, it should come back as 285K after 5 years. And average, the cash on cash will be about 4.5%. So that's that. And also it has an 8% pref. Why we invest is, we like the location and the submarket. Those are some of the data points are there. We have a clear rent growth. That means we are not going in and proving a concept. Our neighbors has proved the concept. We're just following through. That means we are catching up. It's not we're trying to push the entire market. And we also think it's better because downtown is coming. So pushing against the market will be problematic. Rather, we're just catching up. So it gives us less of a work to do as you go. Extremely low levered transaction, 52%, and you'll see how that happens. So debt and the volatility perspective, we are in a much better shape than other assets that we have. In place, the rate that we got, 2.9% fixed, 12 months IO. It's a fix for 9 years, so we have a lot of time to finish our business plan and pass it on to somebody else next go round. And the purchase price, we were happy to say the purchase price is quite a bit below the market, 124K a unit. And our exit cap at a 5.5%. We ran some volatility, and at some point we said, okay, what is the absolute crazy thing happens? We said, hey, if we are wrong even 30-40%, we're still at par with the market. We're 19 IRR, 2x multiple. So this project we felt pretty healthy, and we have a lot of flexibility within this project. Last couple of webinars that we went through, question was asked, why do we believe the rent up is pretty high? So we thought we'll show a picture. So on the right side, so on the left side is our McCallum property. On the right side, right there where the arrow is, that's a tiny little building. This is one of the 14 buildings. That's our asset. And this is literally next door. It's like if you look at the property on the right side and left side, the Tides. And Tide just finished their business plan. And you can tell they have finished and look at their rent. And compared to our in-place rent. There's quite a bit of blended rent bump that we can go exercise from them from 770 to 1195, almost 1200. We have quite a bit of rents that we can organically catch up as we go. Now we'll get into the property a little bit. Shane, would you mind? I would take it from you a little bit about the assets, and then we can talk about the business plan. That's okay.
Sure. Yeah, no problem. No problem. So yeah, this great job, by the way, so far, Shrar. I love your delivery. So yeah, this is 419 unit asset. It was actually built 84 and 85, but it was started in 84 as a 2-year project. So the occupancy is actually closer to about 95% right now, but fair to be a conservative at 91. We do have a little bit of a smaller average unit size, but as you probably maybe saw on the prior slide, we actually have larger units than the Tides deals on either side of us. And so we feel like that it's not necessarily a detractor that the average unit size in the predominant 1-bedroom unit matrix is fine, because that is what's in the market, and there's extremely strong demand for it. And so with an average in-place rent of $792, it's just dramatically low. It was very clear when we did our rent comp analysis that there was low-hanging fruit here and really room to push rents. And our average market rent for renovated rents at $1,115, as you may note too, is less than what the Tides Equities deals on either side of us are already achieving today. And our pro forma rents are not projected to be achieved until really year 3, or in a rolling process and cadence over the next 3 years. So for those reasons, we feel like we're sufficiently conservative relative to the pro forma and business plan. So the location is right in McCallum Boulevard, far north Dallas. And I just want to talk a little bit about that, because one of our slogans, we should probably put it right under our logo there, is that we buy neighborhoods first and assets second. And we take that very seriously. We really drill into the neighborhood demographics. As you probably saw on a prior slide, we've got 20% population growth in this submarket over the next 5 years, which is coterminous with our business plan. So we've got 20% population growth and no new supply coming online, and no place for it to come online because everything is built in this particular pocket. And so we have this really interesting little pocket of workforce housing that's surrounded by really nice residential properties all the way around it. You've got UT Dallas to the east, which I think is a pretty important little component of the location. And we do feel like that there's an opportunity for us to attract some of the grad students from the university, get them an off-market apartment in our community. It feels a little more residential, a little more quiet, a little more home. It's away from the sort of college campus scene, and it's that close. You could walk there. Just north of us, Central Market, an amazing, new, just right up north on Coit, an amazing new retail development, Whole Food centered, and sort of high-end retail, Lululemon, those types of things. And so the developers that put those retail developments in really study demographics, really understand what the population dynamics are there, and they obviously have invested billions of dollars in those types of developments. So we feel extremely positive about this little pocket, and frankly, we'd love to buy more assets here. So there's the bottom part of that last slide. They are 3 and 4 stories structures, and there are 14 of them. And we have had all of the major building systems are in good shape. We did a very thorough due diligence, like we always did. 100% of the roofs were replaced by prior ownership and the one before. All of the infrastructure, MEP, windows and such are in good condition. Other than, I don't know, sure, I'd like to maybe update from my first monthly update, what we found when we acquired the property, which I think is important to share, right? Whenever we buy a property, there's always something that we learn. There's always something that we couldn't uncover for some reason. And one of them is that there were about 25 units in this asset that were without hot water, and they didn't have hot water for about 4 months. So while we were under contract to buy the asset, a valve went, and prior ownership didn't fix it. And so, oddly enough, these residents stayed. I can't believe they lived like that for 4 months without hot water. But suffice it to say, when we found that out immediately, first week of ownership, we immediately took steps, fixed it. It was about a $22,000, expenditure that we hadn't planned for. Of course, we have sufficient CapEx reserves to be able to cover that. And so, question you might be asking yourself is, well, Shane, why didn't you find that in due diligence? Why wasn't that found? How could you not have figured that out? And so, our process is always to get a report, which is generally downloadable from the city, from the county, of anything relative to health, code, safety, or other violations at the asset. And so we did that, like we do on every property, and nothing came back. There were no defaults or no notes. There was nothing in the system at all with the city of Dallas at the property. And so what we've created now is a new SOP for that, which is that we call them, or we physically go there and meet with the building staff and the health officials to ensure that there's something that they may know about, but they haven't written the property up yet on, which is the situation here where they knew about it, and they were in active discussions with prior ownership, but they didn't actually write the property up or give them a citation, and therefore our system didn't grab that deficiency. So we've now incorporated that as a new standard operating procedure on our due diligence, and that's just one of the fun things you find when you buy a new property. And there's a skeleton in the closet that you couldn't just figure out in due diligence. That was the one. There's always one, and that was the one here. And thankfully, it wasn't that bad. And the good news is, because we acted so quickly, corrected it so fast, we now have 20 plus glowing reviews and extremely pleased residents that are ecstatic that we bought this property.
Shane, thank you.
Yeah. So sorry about that big segment.
No, that's okay. That's a good story to tell, by the way.
It's important, right? This is real stuff. This is what happens when you buy assets, and these are the real world things that occur when we're dealing with properties. So look, the value add opportunity, 90+% of the units are in classic condition. So we're going to 17 specifically have been renovated by prior ownership. We're going to renovate 402. We've already started the exterior cosmetic improvements. We've already upgraded the amenity enhancements and pool area. So everywhere you see there that's concrete with those sort of hideous blue chairs and tables, that's all gone. We've replaced it with a nice AstroTurf green surface. We've got games in there, foosball, all sorts of different movable games and activities for residents. The reviews from residents are amazing. They're ecstatic that we took those actions immediately, really dressed it up. The clubhouse, office space are already being renovated, new floors, new paint. The gym's getting a complete makeover, all new equipment, completely refreshing everything. And that's already underway and in process, as well as the exterior repairs, the tree trimming, the landscaping, exterior retaining walls, part of the landscaping that are already being repaired, and some of the minor exterior deferred maintenance on the building prior to painting it have already been done, or underway rather. We've already rebranded the asset as the Landing at McCallum. And so the signage has been ordered, the logo has been selected, and the color scheme to go along with it. And one of the more important sources of additional income is adding the washer dryer hookups in the units. And so we are proceeding with that. We've identified our first 6 units of turnover that we're going to be starting here next week. We're excited to get the interior components going. We also have given the deposit for the parcel pending service, the parcel lockers that are going to be added to the property, which again is just going to be a huge amenity for the residents, and they're already excited about that they know that that's coming.
Thank you, Shane. Here it's a little bit about what Shane was mentioning about the submarket and the location and the price. The key takeaway is this one. The neighborhood median price is $531,000. And if you think about it, the offset of the single bedroom, 500 and a square footage of units, what we're looking for, it's a very solid workforce area right by the college, but all it takes for you to make $60,000, $65,000 to get in, because you can afford a $1,500 rent payment and still live close by to the high-end retail and close to the good setup. So in one sense, yes, we're skewed toward more of a single, but we believe it's a better play because we're targeting that, single jobs, $60,000, $65,000, $60,000 to $80,000. It could be a grad who come close to it, and setup perspective, the turnover, we don't see that much as well. I believe I was there a couple of weeks ago at night. I saw a couple of grad students with the backpack walking around. It felt like they were a grad student going to the property as well. So this is it's a little bit more example at the submarket plus the rent growth for McCallum. The blue line is this is the McCallum, and the submarket is there, so it's quite a bit of spread. As we mentioned, the tides are the biggest spread between those two. So business plan, it's a very I would say it's a very simple business plan per se. There's nothing crazy that we're going to do, which is we're taking a tenant class, swapping out the different tenant. The first one is the interior renovation, and the other one is the rental income upside, the best-in-class asset management, and hands-on asset management. So I'll kind of take you guys through. We have allocated about roughly $7,700 per unit for the unit renovation, and also we have the exterior. So we're going to exterior first, then we're kicking in the interior. I believe interior renovation started this week, and then we're going to continue to do so. And then the submarket current market rate is $961. In place is about $150 lower than that. Our neighbors rent, it's about $1,100, $1,200. So we believe we can get closer to our neighborhoods and the neighbors rent without doing much of a push on the rent, just because we kind of showcase the property right, with the light, the appropriate lighting and the color, and do the significant rent. I mean, rehab inside, we should be okay. On the asset management perspective, Shane and I, we talked quite a bit. We have asset living, and we have a backup of the asset living just in case. So we have a very tight list, a very tight margin of error. We're almost like a hockey stick where we manage. This is where having a full-time associates in a team who are managing the asset on a day-to-day basis, having a CapEx construction manager in-house, who looking at the CapEx, who worked through the whole closing process, who had the vendors lined up, where within a 6 weeks, 5 weeks period, we finished some of the work already now, vendors coming in line for that. So that is very important. So asset living, it's our property management company, and they took over. So far, so good. And just in case something were to happen, we have a backup property management company as well. And we have a very time and a limit that if the performance deviates a certain way, we'll act it. So some of the questions were asked, how Hampshire and Massive works together to manage this asset. That's where the hands-on asset management. If you think about the frequency of the time, at a day-to-day basis, we have construction manager and the asset manager from Hampshire works with the property management company. At a weekly basis, we have our calls all together. At a monthly basis, we have our calls all together. We have all the access together. So we are shaping the strategy longer term. We're shaping the, making sure the KPIs are right. We're making sure how the cadence of the meeting goes. Then at a day-to-day basis, we're leaning on Hampshire. So it's an open conversation for us. It's a joint delivery for us. Shane, this is back to you. Walk us through on your assumption. So this is, I believe this is a good way of model. So as you walk us through, I kind of highlighted some of the sections that we think it's very important when we analyze a project at this size.
Yep, absolutely, Shraj. So the first thing that I want to point out is when you take a look at the T12 versus year one, that's a very important thing. And what you'll notice is that physical vacancy and economic vacancy, we are projecting to rise, right? So that's going to go up, even though our gross potential rent rises. We are absolutely budgeting and expecting for physical and economic vacancy to go down, right? So that's why those numbers are negative, and to continue that to have that diminish in year two, stabilize in year three. That's how we underwrite all of our assets for this. We've done a number of different full cycles for this type of project, and we're modeling the renovation timeline to be about 30 months. So it's in concert with, it's actually less than what the typical monthly vacancy is at the property. So we feel like that's a good conservative estimation of that. And then again, you'll notice maintenance and turnover goes up quite a bit. Salaries and staffing jumps up quite a bit from T12 to year one. Insurance, taxes, and essentially, most of the major line items, we expect to grow those substantially, so that when you look at the NOI for year one versus in place, it doesn't move very much. It's relatively flat, and that's because we're pretty conservative in terms of how we estimate that. The real growth in NOI happens, year two and year three. And that's really where we get the biggest turnover. So that year one is really a stabilization year. We're really driving the revenue growth. We're expecting, to re-tenant the property. It's a pretty big rent bump, right, to go from $792 to $1,100. We're not expecting to do it on every single unit there or in the first year, but we do generally expect about 50% of the units that become vacant that we're going to have to re-tenant with new residents, and so that's why you see the numbers in the pro forma in terms of physical and economic vacancy the way they are. And then I just want to point out too, the debt service payment changes from year one to year two, which affects our cash flow a bit there, and that's because we only have 1 year left of interest only on the Freddie Mac debt that we assumed. And so it starts to amortize in year two. That's why that debt service payment goes up by that much. But of course, we're also at that same point in time paying down the mortgage on the asset at $600,000 a year. So that's additional equity in all of our pockets from there.
Shane, thank you. So, just to kind of case in point, we have another property, San Antonio, that's under contract. The DSCR for the first year is 0.7. Point A, and it's 1.2 and year two. And if you look at the health perspective, this is a value add, but not a complete barn and churn then come out. This is a value add, keeping the low leverage and high grading the tenant on the payment basis. So one of the questions was asked at the previous management company when the bankrupt, what happened? As you know exactly what happened, a year and a half ago, they took a major dip. I think that they went up to 78% at some point. Then they brought in a new management company that brought it up to almost to 90% as of now. So they went through the pain of shuffling through the non-paying tenants and bringing in the paying tenants, but on the lower echelon of it. Now we're going to go back and high grade those tenants to the higher dollar item. So this is the beautiful financial structure that I love. On the left side, if you can take a look at it, the total projects, it's about $60 million there. And it was a $30 million senior loan. The bank, Walker Dunlop came in $20 million, $19.4 million check. And then LP equity, it's about 8 and 6. And then sponsors about $1 million, total 60. So this is the seniority of the debt as well. Since they coming in with a much larger check, The IRR cutoff is 12, but as a trade-off, they wanted the first dip of the tax. That boils down to here, the first year, the project cash flows day one. From the LP perspective, the cash goes back to Walker Dunlop first. In year two, we start getting the distributions out. So third quarter of the second year, the first time we'll issue the distribution to the LPs, then it's kind of goes back up. And that's the yearly distribution looks like. All in all, it's about 185% return, which is $100,000 becomes 285, and IRR is 24, average cash on cash 4.6 and 2.8 multiple. And I kind of highlighted that, hey, it's a trade-off, right? So the beauty of it that they're taking a low IRR and we are gaining much higher IRR there. On trade-off, they're getting the first year of cash flow. So since we took over, so this is where that Shane was mentioning that we took over 5-6 weeks ago, and already exterior works started. We got the AstroTurf, and those are the exterior amenities that are going into place. And as you know, 5th, which is this week, that's where the work is starting to happen. So the unique repairs at the bottom side of it, that's I just want to kind of share, is that we will slowly ramp up 120 days. We're not going to go in. It takes a month to kind of get the property management situated and at least to make an impact. And then you're in a month 2, 3, and 4, once you settle the system and the process, everybody is in the system, all the tenants, we find out all those onesies, then we get ready to go. So our targeting, when we go through the initial process, we're targeting about 13 rentals per month at fully ramped up. That's about Q2 of next year. But now the point is we are already actively working on it and have delivered the CapEx. I believe last time when I checked, Shane, we spent a little around $250,000 already that we also filed the reimbursement to the lender to get the money back. All happened in 30 days, right? That's the benefit of having vertically integrated team, looking through the process and really realizing the economics of scale.
That's right.
Anyone add something to it? Okay. So next step, it's very simple. It's a 506C extra investment. So all you can do is sign our, go to our website, massive.capital or PSCs, or the link from that Ash sent out. On top right, it says, investor sign up. You just click there and then read the PPM and the deck. A version of this deck is there. And take a look at it, sign up. And once you sign up, one of our team will call you. And then if you have any questions, we'll talk through it and we'll go from there. And then overall, we believe it's a higher risk-adjusted return compared to some of the other projects that we have seen. And again, the trade-off is the first year cash. But the beauty is we have an institutional partner with us who helped us to getting that kind of a return to the LPs. So we would like to close that out by end of this year, so everybody realizes the benefit of the tax. Again, assuming you're set up for it, please talk to your CPA about it. But at least you're in a place where you can realize the 100% depreciation and that. And we're already 60% subscribed, a little over 60. So deals already closed. So what I say from the finance perspective, that as we come into investment early on, we always have the closing risk, we always have the takeover risk, then we have the operational risk. At this point in time, the closing risk is out, and that whole takeover risk is out. The operational risk is there. So risk-adjusted perspective, it is it's a better place to come into the deal. Okay. That's all I had. I'm open for Q&A. I see some hands raised. Mike, would you like to help me out with the questions you have? And Shane, you and I will take it from here. David?
I'll go ahead with David Johnson. He's had, I don't know if he's intentional or unintentional, but give him a chance if he wants to ask a question or share.
Sure. I just had a quick question about right now you're 91% occupied, right? So I'm wondering, how are you going to move the tenants out so you can start doing interior rehab? How's that going to work out?
So you want to go? I'll go. You can go. Then I'll piggyback on you. That's okay.
Yeah, sure thing. So good question. And so if you think about 419 units, and even if you just took 5% vacancy, that would be 20, 21 or 22 units per month that are vacant at any given time. And really, we're only expecting to, as Schreier laid out, we're going to start with 6 units and then do 8, 10, and work our way up to an average of about 13 per month. So we're really not moving anyone out. That's just part of the organic vacancy. So we're just staying. We're not physically forcing anybody out. We're just working with the vacancy that we have and turning units as they become available.
And just to piggyback on that one, so we have a KPI we call ROE, return on effort. So lease is expiring, right? And for us, we have a target rent to get. What we're going to do, we're going to offer a price which is closer to the market rent, right? We'd like them to stay. Retention is expensive, and it's good for them to stay. And it's still, if you can increase the rent, so everybody whose rent is expired, we're going to bring them in a market rate. If they choose to stay, it's fantastic. If they don't, then organically we create the vacancy to go back and do the interior renovation. Good question, by the way.
Perfect. That was a great question. Thank you.
No problem.
And since this is kind of a college campus kind of thing, right? So maybe we can ramp up the renovation during the vacation time when all the kids are out. Have you thought of that?
I could give it a shot. So as a part of the answer is yes. So as we do the analysis on a rent roll, one thing we take a look at it is the timing of the churn and the churn ratio, right? So when we cluster that, when we do that, to think about a scatter plot, right? We have the duration of the time and the quantity of units. I'm just walking you guys through on the scatter plot we kind of follow. So this one, it's a blend between, there are families with the kids, but not a whole lot. And there are some students, but not a whole lot. So we didn't see quite a bit of cluster in the summertime. So you're right, we're actively looking ahead 30 days, 60 days, 90 days, and who are coming up for the lease. And we try to, re-sign them for the in-place tenant with the higher rate. And if it organically comes through, we'll go. But short answer is we don't see any cluster yet where we think we can do it. So our pace is as they come in, we'll go.
Thanks. Hey, so let me do 2 things. One is we are at 7, so not kicking anyone out. We'll be here for another 15 minutes. And also then we'll move over to some other questions. And I wanted to mention, we also have Michael Menudo is going to post in the chat about a partnership that we're starting with him. So if you get any questions, take a look at it, connect with Michael and follow up with him about opportunities to partner with him and us towards what's called the Deal Doer Machine commercial. And just follow up with that way. And we'll be catching that up in the next webinars coming up in the next week. W, let's go to you. You can unmute.
Thank you so much. Jim, I'm just curious. I know this is 419 units, so that's quite a bit. Are you planning to have any staggered type quality units and rents, or is the intent to have the entire project upscaled and rented at the current market? Like in some places they have a medium renovated and maximum renovated and all of that. Are you intending to do any of that kind of mix?
Jen, you want to take it? I'll pick it back after you. I want to make sure that we both of us are talking, so we know.
Sure.
Great
question.
Thank you.
Yeah, no, that's a good question. So the renovation program is the same for all the units. However, to your point, what we do is let's say we have 20 vacant units. We're only going to renovate 13 of them. We pick the units that need the most work, right? If there are units that are easier to turn, we'll just do a quick turn on those, get them back on the market, and still ask that market rent, not the renovated rent. So we're still getting a rent bump on our turned units, but not the full bump to the renovated rent. And so there will be different tiers from that perspective, but not different renovation tiers.
I see. All right. That's a great, thank you. Thank you for that.
So in general, we'll have 3 buckets, which is the classic, renovated, and something in between. Where if the margin, it's not a whole lot. So we're just going to keep it new paint, clean up carpet, or change the carpet, and we go.
Yeah, that's what I expected to see. So, but it wasn't clear for me, but I thank you. That really clarifies.
Yeah.
Simon had a question.
Yeah, Yeah, I do have two questions. Quickly, what's the collection like for this property? I know we just moving through COVID right now, but how's the collection?
You had another one, or that's the only one?
So that's the first one. The second one is because there's a hard money loan in place, I want to know how that affects the LPs that are investing as far as like, you know, like the capital stack, how when funds are distributed, things like that, how does it affect everything?
Yeah, good question, Simon. So the first question is that collections were relatively stable. They definitely took a hit during COVID, like they did in most places. But what we've seen is that over the last 12 months, the collections have been very solid there, and we continue to track that obviously through our contract period, and the collections have remained strong at the property. And then to your second question, no, LPs and LP interests never get diluted in a situation like this, or you know, in a if there's an additional fees, let's say for the loan, that's really all on the GPs, all on the general partners completely. LP returns stay insulated from any of those things.
Great, thank you.
Something, okay, one of the question was asked, Mike, about the EV charging station. I believe it's not in the business plan, but we have an eye out. If we feel that we can monetize, I believe, yes, that's a very good point.
Yeah, I think I answered most of all the questions in the chat. I think more were like comments about you could look at solar panels, EV, stations, color, to be able to, somebody look at different colors and but I think everything else was addressed in the chat. If I missed anything that somebody asked in the chat, drop it again real quick and we'll answer it, or raise your hand.
Question about 1031. Shouldn't be a problem with the 1031, right?
Shane, I'll let Shane address that one. We talked it over. There is space for one, but I'll let Shane add a size. Yeah. Go ahead, Shane.
Yeah, that's exactly right. There's a pretty big cost and timeline and process to add that to the loan assumption, and to get them into the loan assumption process and sign on that. We can do it, but it's really got to be reserved for a larger check size.
Jonathan,
go ahead.
Yeah, just a quick question for Mike. Last time you mentioned that maybe there is a chance to go to see the property this coming weekend, so it's still open.
Yeah, I'm organizing for Friday. I gotta do a follow-up, but I think we're targeting Friday at 4 p.m.
Awesome.
Most of the people that are in the event going on Friday are supposed to be finished at 3. So this is the property is like 5 minutes away from where that event is. So it's super gives you also a feel like of how good the location is, because of how close it is to a lot of great areas around that north area of Dallas.
Awesome, thank you.
Mike, it's 7:07.
Yeah.
I don't think so.
I
Have
don't
any
see any
questions?
other questions. I'm going to post one more time our link if anybody and go to the QR code as well. Sure.
Okay, sounds good.
Just last chance here. If you want to see more of this, connect with us more, scan that code or click the link there. Yes, so, yes, and the investment is open to IRA investments and LLC investment. You know, they're 401k, solo 401k investments. So, you know, there's any way that you're really can imagine that you have money, it can be invested into the property.
Shane, and so Shane, really appreciate your time. I know it's
Thank
late
you.
in the day. Thank you. Paul, Ryan, Lacey, really appreciate it. And Ash, I know you're busy. We appreciate time during the lunch today and also the time in the afternoon today. And I hope you have a good, great trip. Now to close out, Paul and Ash, if you'd like to say something, please take it away. Paul, you want to go first? Then we can go to Ash.
Yeah, I just want to reiterate, we see a lot of properties and this one is an awesome one. The returns are great in this economic market. And so I'd encourage people to really take a look here. It really is great return, great asset, great team. So.
Thank you, Paul. Ash?
Yeah, I was just going to Sure. I was going to say the fundamentals of this property is indeed really spectacular. A lot of things, there's a huge upside potential. I mean, it kind of checks most of the boxes, and occupancy is good. And I think with the great asset management from Massive Capital's part, and you guys always keeping your eye on the ball, I think this is going to be a huge success story. So yeah, I'm excited to be a part of this, and it would be great for as many people to participate as they can.
Thank you, Ash. Thanks, everybody. Mike, back to you. Gonna close it.
Yeah. Oh, wait. Sorry, I saw another. Yeah, okay. All right, yeah, just I was reading through, there was the chat like lit up here at the last minute, so take a look there while I was closing out a bit sharp. But no, there's nothing else really tonight. We really appreciate everyone. As I said, if you're, reach out to, any of your, team or sponsors that are here tonight. We've seen quite a few people on tonight. Reach out to them directly, reach out to us. Again, we will be up in Dallas this weekend, Friday and Saturday. So if you want to connect with us, let us know. And then the following weekend, again, we'll be in Aventura, Florida, the 16th, 17th, 18th, and we have an event we'll be doing on the Friday and Saturday that weekend. So other than that, have a good week, and thanks for everybody's time tonight. We'll if we missed anyone or any questions here in the chat, we'll get to those and address those as we go. If we'll reach out to you later if we missed it in the chat tonight. So thank you all very much. Have a good evening.
Thanks, everybody.
Thanks, everyone.
Good
Appreciate
evening.
it. Yeah.
Bye. Thank you.
Have a good night, everybody.
Good night.
Good night, everybody. Thank you.
Good night. Thanks for everyone coming. Great questions.
Yeah, there's some good questions today. And Shane, thank you as well. I know it's late.
Guys, you killed it. A good presentation, Shirar and Shane.
Thank you. Shane took off. Shane was like, I'm busy. I'm out. Boom. Hey, Mike, just because before I forget, 9:30 your place, right? Tomorrow meeting.
Yeah, 9:30. What'd you say? 9:30.
9:30, right?
Coffee shop.
Okay, I'll get coffee for everybody so we can kind of get a head start.
But I have so we can get a head start. Okay, now you're like changing the. I
so
said let's meet at the coffee shop. It's right downstairs. It's like I walk out of my apartment and I walk into the coffee shop.
Sounds good. I think I need to buy everybody coffee. It's gonna be a long day
It's
tomorrow.
a new Mexican coffee shop. It's the only one in Houston, I think.
Okay. we need a lot of coffee before we
It's
start.
not
the meeting.
Starbucks. It's not gonna be Starbucks, but
That's my, remember the biggest one you buy and the
but they
darkest one you buy.
got everything that you need, though. They've got it
Okay.
all.
So Simon, tomorrow we have a long meeting, like 4-hour strategy session. And so we do that every 4 or 5 months or so. We sit down, bring the team. We look at what we're doing, performance, how we're gonna move forward. That's tomorrow. And typically it's a day long, right? And we're pumping a lot of coffee so we can focus, get the energy level high, and so we can kind of go through that. It's a lot of brain draining exercise tomorrow. It gets fun. So that's tomorrow. So, okay. Mike, I want to take off, buddy. I got some kid duty to go. I looked up twice. So thanks, everybody. Good night.
All right, see you.
All right, sure. See you. Wait, give me a host just before you
Okay.
close. I need to go through some.
Mike, where's Mike? I can't even find you in the whole thing. Oh, I'm looking for Mike. It should be massive.
Oh,
So you're a co-host. So
yeah.
Thank you, Mike. Thank you, Jonathan. You guys are great.
Hey, so I was looking for you. So you were. Didn't see you still in the. If you were still here, so I saw your message. Great, glad you came. And glad Alex shared this over to you to join us tonight.
Yeah, just I mean, Alex, I think I got it from him. I keep getting different messages and I'm jumping all over the place. And so, but hey, I mean, I know you guys are together with team, Jonathan, you too as well, buddy. And I'm very happy to see. I'm just observing whatever I can get my, I just get out. I was in the hot springs in Idaho, and I was like, okay, where I'm jumping in tonight, and there was no internet. So I had a few phone calls, but I was like completely, there was like in the middle of nowhere and no phone connection. And the minute I started driving my truck, I saw you guys and I jumped right in and I see everybody. So I keep it on the back line. Soon I'm going to speak more. I mean, once I start doing more from Alex's mentorship and, just I'll be getting on the front page, but I'm very, very happy to be here. Just want to say hello.
Oh yeah, awesome. Glad you're here. I was trying to figure out what you were. It looks like you're in like a club or something.
Actually, I'm on the US 93 going towards Vegas, and this is the first casino after Idaho, and I'm just gonna have some meat because I'm freaking hungry.
Cool. Sounds nice.
So it's a mini restaurant. It's not a big deal. I have a question, by the way, since I don't want to take time from everybody, but do you guys have like together to make phone calls? I know, Jonathan, you can do phone calls by yourself to brokers. I know, Mike, you guys are ahead of the game, but is it possible